Hi, this is Accounting 201, Principles of Accounting 1, and my name is Judith Paquette, and I'm your teacher. This short video is about the rules of debit and credit. We are going to talk about the rules of debit and credit, how to make a journal entry, how to post to T accounts. And those are in order. So subsequent topics will be posting those T accounts to a trial balance and then creating the three financial statements. As you know, there's four financial statements, but Accounting 201 we focus on the three: income statement, retained earnings, and balance sheet. The worksheet is where we started out. So here's the worksheet. I really like it. It helps you get the idea of the accounting equation, assets equals liabilities plus stockholders' equity. And it helps you get the idea of transactions and how the transactions just have to balance. Stockholders, transaction 1, 15,000 on the left, 15,000 on the right. Stockholders invest $15,000 of cash in the company, cash goes up, and this also creates common stock that the company now has. The company now has stockholders, and so forth. Each transaction has to balance. So in this second equation, we purchased equipment. Equipment went up. Cash went down. All of the transaction occurred on the left side of the equation, but it balanced out because it zeroes out. We increased one asset, we decreased another asset. And I'm going to say right now that I really like the expanded accounting equation. Assets equals liabilities plus stockholders' equity, which includes common stock and retained earnings, plus revenue minus expense minus dividends. Okay. So let's talk about the rules of debit and credit. And let's just say right now that debit and credit each of them have only one definition. Debit means left. Credit means right. They do not mean increase or decrease all the time. It depends on the account. So the T account, every account has its own T account. Cash has its own T account. Accounts payable, common stock, retained earnings, each has its own T account. And they're used to track each account's activity. We did that in the worksheet, but in 10 transactions, we filled up a whole page, and we have lots of transactions. So the T accounts actually work better for us. So each transaction must affect two or more accounts. So you're going to see a journal entry in a minute. Just like we did on the worksheet, each transaction must affect two or more accounts, and it's all about keeping the basic accounting equation in balance. And then we will create a journal entry. We will record the journal entry by debiting at least one account and by crediting at least one other. And of course, we're all about balance here. Debits must equal credits, not on the T accounts, but on the journal entry. So here's a chart with the rules of debits and credits. And you'll recognize this formula again. Assets equals liabilities plus stockholders' equity plus revenue minus expense minus dividends. These are the account categories, and underneath them are the accounts. We don't book journal entries to the account categories. We book journal entries to the individual accounts. So here's the rule. And this is color coded, but debits, 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 credits, credits, credits. So when we increase an asset, we go to that asset's T account, cash for example, and if we say we want to increase cash, we will debit it. So that means we'll book the journal entry, that part of the journal entry on the left side. Same for accounts receivable, same for supplies, land, equipment, for all assets. When we increase them, when we post that on the T account, we will write it on the left-hand side. Liabilities, we increase liabilities by crediting them. Now, how are you going to remember that? Credit has an R in it. And it's on the right side of the equation. And the equation stops here. So we increase accounts payable, we'll credit it. Therefore, when we decrease accounts payable, when we pay a bill, we'll debit it. Common stock and retained earnings, also on the right side of the equation, also increased with a credit. Service revenue, also increased with a credit. Now expenses and dividends, yes, they are on the right side of the equation, but see that minus sign? We reverse it, so we increase expenses and dividends with debits. All right, let's take a transaction. Assume a company has a beginning balance of $100,000 in cash. It then buys a car for $20,000 and pays in cash. First question I always ask, was cash involved? And if it was involved, did cash increase or decrease with that $20,000 transaction? Of course, cash went down, it decreased. Now let's apply the rules of debit and credit. Assets go up with a debit, but in this case, cash decreased. Therefore, you must credit it. But what about the other side of that transaction? We bought a car for $20,000, and let's book it to equipment. Let's keep it simple when we buy long-term assets and call them equipment. Equipment, did it increase or decrease? Equipment increased. How do we increase an asset? Oh, sorry for the overwrite there. We increase an asset with a debit. Okay, let's create a journal entry. Here we go. This is transaction 1. Let's say it happened on January 1st. We increased equipment, so we debit equipment. We decreased cash, so we credit cash. Please note, debits equal credits. And also note that I like to put descriptions here. You're not required to do that for homework or exams, but it's a good general rule. So you've just seen your first journal entry. How would we post this journal entry? Okay, see there's 2 T accounts, one for cash and one for equipment. And remember we had a beginning balance of $100,000 in cash, but we're posting transaction number 1. So we're crediting cash and we're debiting equipment. This $80,000 here is a calculation. It's the difference between the beginning balance and the credit of $20,000. Let's take one more journal entry. Let's say the company buys $2,000 worth of supplies on credit and they'll pay in 30 days. Was cash involved? And if so, did cash increase or decrease? Now we use the term buy in this transaction, but we also say on credit. So when we say on credit, cash is not immediately involved. Cash won't be involved until we pay the bill in 30 days. So this is not a transaction that involves cash. So what accounts are involved in this transaction? Supplies, we increase the supplies account, which is an asset account, and accounts payable. We also increased our debt. We increased our liabilities. What are the rules of debit and credit? Well, supplies increased. Supplies are an asset. Therefore, what do you do with supplies when they increase? Think about that. The other account that's involved is accounts payable. It is a liability and it also increased. What do we do with liabilities when we increase them? So what's the journal entry going to be? Supplies, rule of debit and credit, asset, we increased an asset, we will debit supplies. Accounts payable is a liability. When we increase liabilities, that's a credit. So let's take a look at that journal entry. Again, this should say transaction 2, my bad right there. Transaction 2, January 1st, 2014, debit to the supplies account, credit to accounts payable. Debits equal credits, and there's my description. Now please note, we increased both of these accounts. We didn't decrease either one of them. Debit and credit don't mean always increase or decrease. Increases don't have to equal decreases, but debits do have to equal credits. Now let's post this. Supplies has its own account. Accounts payable has its own account. We increased supplies with a debit. We increased accounts payable with a credit. That ends this video. Thank you.